Feds just raised the rates again for the 11th time since March of 2022, this last Tuesday, and the general consensus is that Feds may do another rate hike before the end of the year since we have 2 more meetings left. But despite these rates being high, we have yet to see home prices come down, which a lot of us are keenly waiting for. So in today's video, I'm going to share with you what today's current interest rate is and what to expect in the second half of the year. So let's get started. Before we move forward, let's talk about the recent past. So in the last 12 months, we have seen inflation come down consistently, which is great news for all of us because that is what the Federal Reserve is focused on. And in the later half of last year and early of this year, 2023, we've seen a lot of tech layoffs. But since these job layoffs were done to people that were highly educated, for the most part, we didn't see a negative impact on this where a lot of these folks were able to find replacement jobs. Now, another positive report is the core CPI, which is trending downwards, and we just saw that used car sales have gone down, indicating that consumer spending is down. Another goal for the Federal Reserve to bring down inflation is to bring down the core CPI. A lot of economists can agree right now that we are not in full-blown recession, and a lot of them are calling this a rolling recession, or what the Fed calls it is as a soft landing, which is great news for us all, most of us, and not so great news for the market crashers because a lot of people were predicting that the market was going to crash this year, and we didn't see that happen, thank God. So the Feds have raised the rate by 0.25, a quarter basis points. And now let's see a real scenario on the board here to figure out what your rate would be today if you were to purchase a home. So if you're purchasing a home in today's market at $850,000 with a down payment of 20% and a credit score of 720, which is a primary use, your main home, primary residence. And I'm running this in the county of Alameda here in California. County matters because each county can have different types of loan amounts. So the results are a conventional loan in today's rate will be 7.25% and the FHA rate would be 6.25%. Guys, we might have to get used to these rates right now because a lot of people, a lot of economists right now are predicting that the Federal Reserve is not going to bring these rates down, and they're focused on bringing the inflation down to something that they keep on saying, which is 2%. Now, we're kind of a far distance from that point, but if the Fed sees that inflation is starting to come down, then in the next 2 meetings that are left in this year, we might not see another rate hike. We might just see the rates just hang where they are right now. But if those trends start to trend downwards, then the story may be different and they might do another rate hike. So this is something we might need to get used to for a while until we can all come together here and bring the inflation down. To get a really good idea of what the Feds are going to do in the next meeting, pay close attention to the inflation report that's about to be coming out on August 10th, which is in the next couple of days. If you're getting real value out of this video, please hit that like button, leave a comment below, and don't forget to hit that follow button to stay on top of your real estate game. Thank you for watching. Now, moving forward to our next topic, why have home prices not fallen? And you guys may already know the answer to this question. The writing is very clear on the wall. It is due to the very, very low inventory and a healthy demand. So there is this balance and kind of like a gridlock in the market right now where prices are not going anywhere. Yes, the rates are very high, but then you have sellers that are not putting their homes on the market and a healthy demand of buyers that have good jobs. Even despite the rates being high, it makes sense for them to buy. So there's just not enough inventory right now on the market for these buyers. And as you know, supply and demand always dictates pricing. So for us buyers out here, I'm talking to you buyers, for buyers to see prices drop, we're gonna need to see more homes on the market, more new homes, more existing homes, where that inventory goes higher than the demand to see some changes in the pricing. So now we're gonna look at some local data to actually see some tangible numbers. And this data that we're gonna look at is gonna show us where the inventory is in a local market. We're gonna look at the city of Hayward here in the Northern California, East Bay area. Now, these numbers may translate in your market because these trends that I'm talking about with the inventory being very, very low is a universal thing that's happening in most markets in the United States. So we are looking at the Hayward market report, and this is detached homes, which is single family homes. It does not include condos. And as you can see, units sold in June 2023, we have only 59 units sold compared to June 2022. The inventory was still low during that time, which was 83 units. And that is a 30% decline from the same time last year in June. Now, moving forward, year-to-date sold. Last year, the same time, there were 406 units sold, and this year, only 312 units year-to-date sold. Now, this is another interesting number to look at. Average list price. As you can see, the average list price has not really changed much. It's at $1,037,000, and last year was at $1,045,000, only a 0.629% decline. And that shows you right there that demand is still there. Home prices have not fallen. People still want to buy, and there's not enough inventory out there. Sales price versus list price. If you put your market in the city of Hayward, if you're listed at for say $1 million, you're gonna get 7% above the asking price, which is awesome, even though the rates are so high. And the days on market right now typically are 16 days, which is fairly fast for the market that we're in, which means that if you listed your house on day 1, on day 16, you will be in contract. As you saw there's almost 100 homes less from the same time last year. That is a lot of homes that are not available for buyers in the market. That's going to create competition. That's going to keep the prices down because there's just not enough apples out there to shop. So we have a serious problem on our hands right now, guys, and that's inventory. And our last point, what can we expect in the second half of this year? Well, the answer is pretty simple here, that we're gonna see the same trends that we've seen in the beginning or the first half of this year, mainly because a lot of sellers out there are sitting on tons of equity and very, very low interest rates, and they're just not willing to give that up. Now, there are a lot of sellers that are still selling, but these sellers are sellers that own investment properties, or they have to move to another location due to a job, or they're moving out of the country, or there's a divorce happening. These are the main sellers right now out in the market that are selling homes to buyers. Other sellers that don't have to sell are not selling. According to a report put out by CoreLogic, an average homeowner in the United States has about $274,000 in equity, and almost 39% of homeowners in the United States own their home free and clear. That is crazy, guys. That is one of the main reasons we are not seeing sellers put their home on the market, which the interest rates are definitely putting pressure on these sellers to hold on and not put their homes on the market. The biggest threat right now is not the interest rates, guys, it's the inventory in the market. Because if this trend continues and say the rates come down and we still have a healthy, strong job market, then there can be real panic out there in the market when more people that are on the fence right now or just are not qualified to buy come back into the market because home ownership is very strong still, people want to buy, then we can have a really big problem because you have still healthy demand, not enough inventory, and imagine more buyers coming back into the market. That can drive the prices further up or just keep the prices where they at and not have them come down. So we need some serious mandates by local governments and law changes to incentivize, small builders, big builders to build more in new construction. That is going to be a big player here, not just in the local area here in the Bay Area, but all parts of this country, because construction numbers compared to where they were prior to the '08 crash are nowhere near those numbers. So we need to really pick up construction and bring it up to par to match demand. Otherwise, we have a problem on our hands. So if you are a buyer right now, what does all this mean for you? Well, first of all, like I always tell you, I always urge you to talk to your loan officer and figure out what your mortgage payment is and compare that to what the local rents are or what rents you are paying. Now, if you're locked into a low rent and say your rents is due to come up, look at the market rents, because your landlord is probably going to bring it up to where the market rents are, and see how that feels on your wallet. Because I always, even though I'm in this business and this is my forte, I'm never going to tell anybody to buy a home, especially if you're not comfortable making that payment. However, real estate is supposed to be for the long time horizon. That's how this game is played. If you're looking to buy and flip in a year or two, this is not that market. If you're looking to make equity for yourself and save money on rent and not throw money down the drain, and if your pocket allows it, there is no better time to buy than now. I would always say that. It's a loser's game to time the market. And not to downplay it, there are still opportunities in different markets out there right now. In some cases, when the rates go up, what happens? There's more panic in the market. Well, I'm gonna wait. So you might find some deals right now for aggressive sellers, like someone that's going through a divorce or needs to move, that needs to sell that home, and there's just not enough buyers in the market that you're in because of this recent rate change. You might have an opportunity to make an offer on that house, get it, and since there's no prepayment penalties on these conventional conforming consumer purpose loans, you can refinance when the rates come down. That's it for today's video, guys. I hope this video was insightful to you. Until next time, this is Karan saying,